So you want to buy an apartment building, you want to invest in multifamily real estate. What are the ways to do that? How do you approach it? How do you get started? Well, there's several ways we'll discuss today on how you can go about purchasing a rental property, whether it's a single family, 100 units, it doesn't matter as long as it's an income producing property. The focus on this conversation is multifamily, but it could be used for most any asset class. So we're going to touch on three ways to approach purchasing rental property either by yourself, or I should say four ways. Number one, you can buy it yourself. If you have the wherewithal to do it, if you have the cash for the down payment, or if you have the cash to pay cash outright and that makes sense for you, fantastic. Pretty straightforward. Sole proprietor, you can create your own entity, buy it in your own name. We're not going to touch on the differences, pros and cons on that, but if you can buy it on your own, obviously you can buy it on your own. Pretty straightforward. Number two is what we would consider a joint venture. Joint venture meaning you and one other person or more pull your resources together or share in as far as what the building might need. You're sharing the responsibilities, the roles, the requirements of time and equity, the sweat equity that is needed. Now, with a joint venture, you can have one, some, or all of the individuals put capital into the deal. At the end of the day, all individuals need to be involved in the decision making, need to have an active role. So this is a joint venture is not ideal with a few exceptions state by state. But for the most part, if you want to be strictly a passive investor and someone brings you the opportunity to purchase a building in a joint venture, you have to still be part of the active oversight, decision making, management, overseeing construction. There's different roles that can be divvied up, but you can't strictly write a check and expect a return passively with no active component in the role of overseeing that building. That's where the syndication model would step in. So if you're raising capital from other investors and they have an expectation of a return of passive income, that is what's known as a security. And that triggers the requirement of filing an exemption with the SEC. And there's two main ways that most syndicators will go about doing that. There are others, but we'll focus on the two main ones. So you have what's called Regulation D, you have 506C, 506B, and we'll highlight a few of the differences between the two that are relevant in most situations. So 506C is where you can basically broadcast the deal itself. You can advertise, you can publicly solicit. So if you ever are scrolling through Facebook and you see an advertisement for investing passively into a multifamily deal, no matter what state, more than likely, although there are other options, more than likely that's a Rule 506C exemption with the SEC, which allows the sponsor or the person or people putting that deal together to advertise publicly. So that is one difference between 506C, where it allows general solicitation, and 506B, where it's more limited marketing. You'd have to have a pre-existing relationship, a substantive relationship with each and every individual that you bring the offering to prior to the offering being made available. So you can't get a deal under contract and then go meet complete strangers. That would fall more under 506C. 506B, you've already had those conversations with the individuals. You have a good feel for what they're looking for, what kind of returns they're expecting, what makes sense for their family. And that would be 506B. 506B allows what's known as non-accredited investors. So if you don't meet accreditation standards, it does not mean that you're not entitled to invest in a syndication or a joint venture. There's a limit to how many of those individuals can participate in any one given deal, 35 maximum. And as far as accredited investors in a 506B, that's perfectly fine. But all the accredited investors have to do is self-certify to the sponsor of the deal they are accredited. So the sponsor does not need to get a third-party verification of the accredited status. So with the 506C, it's only accredited investors. So that's $1 million net worth or higher, not including your primary residence, or income of $200,000 or greater with an expectation of the same going forward. Get a good feel for how you qualify as accredited investor. If you're not sure, ask the sponsor of the deal, ask your accountant, ask your financial planner, do some research of your own. The answer is out there. I'm just trying to give an idea of the basic differences here. So a joint venture, you can be accredited or non-accredited. It's as long as everybody has an active role. 506B, you can accept up to 35 non-accredited individuals. Any number of accredited individuals who only have to self-certify what their accreditation status is. 506C, you can publicly advertise, and it's accredited investors only. Third-party company has to verify the accreditation status, so the investor has to supply financial documents. So a little bit more arduous. That's a requirement of the 506C. If you have friends that want to invest and you're an accredited investor, you can actually pull your capital together with other individuals into what's called a special purpose vehicle, or say an entity, an LLC, and invest that entity into the deal offering. And that has to be accredited investors only are allowed to do that. So that covers just a handful of the most obvious distinctions between joint venture, a 506B, and a 506C. One thing that's somewhat unrelated to the specific format of the deal that you put together, but keep in mind that if there's a loan on the property, if there's an investor that's contributing typically 20% or more of the capital needed, now the bank will have to underwrite that individual. So in a capital raise, what we're looking to do is, unless they're going to be a general partner on the deal or sign on the debt, to keep any one investor below that 20% threshold. That may not be relevant in all cases, but just something to ask if you're going to be putting a sizable portion of capital into any one deal. So just as a reminder, with most offerings that we put together, either joint venture or 506B, the key is developing a relationship with that deal sponsor, in this case, myself, or for someone else that is putting together opportunities like this. Have a conversation with them well in advance of the offering being made available. Otherwise, you might not have a chance to participate. So you really get a good feel for the character and vision of the deal sponsor, and also the deal sponsor gets a good feel of what's important for you, your family, what your financial situation is, making sure that the offers that are brought to the table are more than likely going to make sense for you and your investment objectives. So make sure to have those conversations well in advance, and that way you can get a good feel for each other. And then when something is made available, you'll be able to consider it at that point in time. If you have any questions, if you have any interest in building your passive income through multifamily investing, I would love to have a conversation with you. Feel free to visit my website at gotimberrun.com. It's GO timberrun.com. You can check out educational material that I post there, also on YouTube and Facebook. And feel free to submit an inquiry if you would like to set up a call with me. Look forward to talking to you, and thanks very much for listening.